Hello, everyone. Thanks for being here. Today, me, Emma, Luena, Olivia, and Matt are going to be presenting our JetBlue fuel hedging analysis. Our goal was to determine which commodity best tracks jet fuel prices, how the relationships changed during the 2011 Brent WTI divergence, and which hedging strategy would have protected JetBlue's fuel costs most effectively. We'll walk through the historical relationships, our regression analysis, and then our hedge design recommendation.
Hi, my name is Emma Fekete, and on this slide, I looked at which commodity historically moves closest to jet fuel and why that relationship shifts over time. Starting with the historical relationship, heating oil is traditionally the commodity that tracks jet fuel the most closely. That's because both are middle distillates that come from the same part of the refining process, so their prices tend to move together. The crack spread between heating oil and jet fuel has also become more stable than the crack spread between jet fuel and crude oil, which makes heating oil a reliable historical proxy. But when we shift to more recent periods, especially 2011, the picture changes. During that year, jet fuel actually tracked Brent crude much more closely than WTI. This happened because WTI became severely dislocated due to the Cushing, Oklahoma pipeline bottleneck. Storage built up, transportation was limited, and WTI started trading at a discount that didn't reflect global market conditions. At one point, Brent was nearly $30 per barrel higher than WTI. Jet fuel markets are globally priced, so jet fuel followed Brent instead of WTI. So when we compare across time, the conclusion is pretty clear. Historically, the best proxy for jet fuel is heating oil. Recently, especially around 2011, Brent crude was the best proxy, and the least reliable option is WTI because of its high basis risk and its susceptibility to localized bottlenecks and trading distortions. Understanding these relationships is important because the effectiveness of a hedge depends on choosing the commodity that best mirrors jet fuel prices during the period you're analyzing.
This slide shows the statistical results that support our conclusions. Here we compare the correlations between monthly jet fuel price changes and price changes in WTI, Brent, and heating oil. For the first historical period from 2007 to 2011, heating oil shows the highest correlation with jet fuel at 0.997. This makes sense because both are refined middle-class distillants with nearly identical market behavior. In contrast, when we isolate the year 2011, Brent crude becomes the closest proxy with a correlation of 0.978. This shift is driven by the Cushing bottleneck, which caused WTI to decouple from global markets and trade at a significant discount. Since jet fuel is globally priced, it followed Brent's benchmark instead of WTI. In summary, the best long-term proxy for jet fuel is heating oil. The best short-term proxy, particularly during periods of market disruption, is Brent crude. And WTI is the least reliable due to structural dislocations in the U.S. crude market, especially in 2011.
Now let's look at the regression results. I ran a multiple regression over 59 months, showcasing the relationship between jet fuel prices, WTI, Brent, and heating oil. Jet fuel prices were the dependent variable, and WTI, Brent, and heating oil were all the independent variables. This model shows that 97% of jet fuel price variation is accounted for in these three benchmarks. That is shown by our squared value. Moving on to coefficients, we could see that heating oil has the strongest relationship, while WTI has the weakest relationship. This means that when jet fuel changes by 1 unit, WTI changes by the least of the group, signifying that heating oil is more correlated with jet fuel prices, and so is Brent than WTI. Looking at the p-value, we see that Brent and heating oil both have significant p-values, whereas WTI's p-value is barely significant. This shows that Brent and heating oil may be a better indicator for predicting jet fuel prices. Moving on down to the t-value section, we see that WTI is close to 2, but it shows a weak and borderline relationship to jet fuel price movement. Moving on to Brent, it's higher than 2, showing that Brent has influence on jet fuel prices, whereas heating oil has a very strong t-value, showing heating oil as an overwhelming driver of jet fuel changes. Now, summarizing our regression results, we can organize the three commodities into a hierarchy of 1, 2, and 3. Number 1 is heating oil because it has the strongest beta, lowest p-value, and highest t-value. It's the strongest predictor of jet fuel prices shown in the regression and can be due to heating oil and jet fuel being middle distillates, which explains why their prices are closely tied. In the regression, Brent is the second strongest indicator with the second highest beta, second lowest p-value, and second highest t-value. And then at number 3, we have WTI, which has the weakest beta, highest p-value, and lowest t-value. And this is especially shown during 2011 when jet fuel prices started falling the Brent more than WTI, which caused higher crack spread and then lower correlation between the jet fuel prices and WTI.
Moving on, we will be discussing hedge design recommendation for JetBlue. So starting with hedge instrument choice, our analysis showed that heating oil futures have the strongest historical relationship with jet fuel price movements. And across the entire sample and in the more recent years, heating oil consistently produced the highest correlation and the most stable beta in our regressions because heating oil is a refined product like jet fuel, so it also tends to move more closely with the physical market. And so for this reason, it provides us with the most accurate and reliable hedge vehicle for JetBlue. And then moving to hedge horizon, we recommend a 12-month rolling hedge for 2012. JetBlue continues to face ongoing and monthly fuel consumption. So a rolling hedge better aligns with the financial hedge and with the timing of actual fuel usage. And this approach allows for predictable monthly expenses and still giving the airline flexibility to adjust as the market conditions move. And it avoids problems with illiquidity or poor pricing that can occur in longer dated contracts. And then finally, for hedge ratio and contract sizing, we use the regression beta between jet fuel and heating oil futures to determine the optimal hedge ratio. And this prevents overhedging and make sure that the hedge tracks the true economic exposure. And since heating oil future contracts covers 42,000 gallons, the number of contracts is determined by scaling JetBlue's expected gallons by the beta and dividing the contract size. So all of this together shows that this structure provides JetBlue with a data-driven way to stabilize fuel costs throughout 2012 while maintaining strong hedge effectiveness too.
On this slide, I'm comparing JetBlue's fuel cost stability in an unhedged scenario versus a rolling hedge strategy, with a specific focus on what would have happened in 2012. Starting on the left with an unhedged scenario, JetBlue would be fully exposed to price volatility in a fuel market. Back in 2011, we saw major price spikes that dramatically increased operating costs, and the same type of volatility continued in 2012. Without any hedge in place, those price movements translated directly into the company's quarterly earnings, creating a lot of unpredictability. This led to high earnings variability and sharp swings in quarterly fuel costs, which makes financial planning much more difficult. Now looking at the hedged rolling strategy on the right, here JetBlue would be using a combination of collars and swaps to lock in fuel costs within a certain range. That helps reduce the impact of things like Brent WTI divergence and keeps quarterly fuel expenses much more predictable. When we apply this rolling hedge historically to 2012, we can actually see that it smooths out the fuel cost path pretty significantly. Instead of reacting to every market movement, JetBlue's expenses would have stayed within a tighter, more stable band. So in terms of the outcome, a rolling hedge would have greatly reduced JetBlue's fuel cost volatility in 2012. It gives the airline much more predictability in its quarterly expenses and protects profit margins from sudden spikes in jet fuel prices. There is a slight opportunity cost if prices fall, but overall, hedging increases planning confidence and financial stability, which is especially important for an airline with thin margins like JetBlue. So overall, in 2012, the hedge strategy clearly would have provided a more smoother and more stable experience compared to the remaining fully unhedged.
In conclusion, heating oil is the most reliable hedge for jet fuel, Brent is a strong secondary benchmark, and WTI carries the most basis risk. A rolling 12-month heating oil hedge would have significantly reduced JetBlue's 2012 fuel cost volatility and produce more stable, predictable expenses. Thank you all. I hope you enjoyed.